ways, I think our clients are just, maybe it's not a referendum against the dollar, maybe it's not a referendum against US Treasuries, but it's really trying to kind of reevaluate their allocation to the United States just broadly.
What do you think about US exceptionalism? As you said, it's interesting, coming back from Milken, people said, what we realized, or what everybody was saying, it was a case of, wait a minute, we're just overweight the US, we need to rebalance, which is what any good investor does. So yeah, we want to put some more money out to Europe. Is that what's going on, or is it really people saying, I'm not so sure I feel as comfortable investing in the US market?
Well, I think, broadly our view is that, two things can be true. One is that the dollar might be overvalued given just, again, where the economic outlook looks like it's going to be with tariffs and some of these other cross currents in the U.S. economy. But also that this is not necessarily a referendum on the U.S. more broadly. If you just think about all of the things that made the U.S. attractive coming into this year, those things, more or less are still intact. So I think, what we're telling our clients is that, again, these fiscal worries have been a concern not only for the past year, but for the past years. And at some point, Congress will have to do something about it. Fortunately, there is actually a lot of fiscal runway for the U.S. We just had our secular forum here at PIMCO last week, and we talked a lot about how kind of the different tools Congress has in order to increase revenues or cut spending relative to other countries. And actually, we have a lot more runway, particularly around taxes, meaning that we could actually increase taxes. Now, again, the political will has to be there, but we're confident that if there really is a crisis, that Congress will actually, when push comes to shove, will actually, get to the business of doing some fiscal consolidation. We don't think that's going to happen anytime soon, but we do think that, again, there is the latitude and the runway to do that, kind of when push comes to shove.
Libby, given everything happening, not just when it comes to the credit rating, but also when it comes to the tax bill, I'm taking a look at the bond market. The 30-year yield rising above 5% briefly earlier in the session, now down at about 4.95%. What's the story the bond market is telling us about the long-term fiscal health of the U.S. economy?
Well, in many ways, I think that, this is what, again, if you just take a step back, coming into this year, even before the election, what we were telling our clients is that fiscal deficits were going to be the biggest loser, regardless of who won, whether it was going to be Kamala Harris or President Trump. And I think in some ways the yield curve, the shape of the yield curve, a more steepener, more bear steepener, meaning the long end being higher, is just reflective of that view that, yes, deficits are high. There doesn't look to be the political will for fiscal consolidation anytime soon.
Right.
And as a result, investors who are investing the long end should get some, some yield premium. And that's what we're seeing in the market today.
Hey, Libby, last question. Just got about 30 seconds here. The point is, though, I think about the other matter, tariffs, which right now we're not talking maybe as much about right now with everything else that's going on, but still out there and still historically high. That's got to have an impact.
Still out there, and this is what we're telling our clients. Our signal from noise here, effective tariff rate looks like it's going to be about 15%. That compares to 3% at the beginning of the year, the highest effective tariff rate since like the 1940s, if not earlier. So I think that this is like, again, in terms of the headwinds for this economy, and that obviously affects the bond market as well, we are still going to see lower growth because of these tariffs. And even though there is this China truce, at least for the next 90 days or so.
All right, great point to end.